Supermicrocomputer has seen its market capitalization fall by more than $40 billion in 2024 as a result of failure to report its financial statements on time. But what does that mean for the stock? Does it mean it's undervalued? I'm going to try and answer that question in this video by conducting a discounted cash flow valuation on this very interesting artificial intelligence company. So let's get started.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So 3 of the inputs that I need to make this calculation is the company's market cap at $19 billion, the long-term debt at $2.174 billion, and the cash and short-term investment balance of $1.67 billion. I also need the company's average diluted shares outstanding at 642 million. And I'm going to use the trailing 12-month free cash flow number of negative $2.479 billion and apply that for 2024 because they've not yet reported their actual 2024 number in terms of the official report to the SEC. So I'm also going to utilize Wall Street analyst estimates for the company's free cash flow over the next 3 years. As you can see here, 2024, there's a gap there because the company hasn't reported their financial statement. But for 2025, the Wall Street analyst expect its free cash flow to turn positive at $690 million and then increase even more to $850 million in 2026. And then rise by more than 3x to $3.11 billion in 2027. I also need the company's beta, which according to Yahoo Finance, its beta stands at 1.28. So now that we have the inputs, we can jump into the discounted cash flow valuation for Supermicrocomputer, starting with the negative 2.5 billion number in 2024. I've talked a lot about how this number turned negative for Supermicrocomputer and how it's normal for a business that sells physical products and experiences rapid growth for it to have a negative free cash flow. And Supermicrocomputer did experience rapid growth, with revenue increasing by more than 100% for several consecutive quarters, and it does sell physical products. So I explained how the company pays cash for the inventory and the products to start with, and then it doesn't collect the cash from its customers until a few months later, which creates that gap between the cash going out and the cash coming in, and it worsens when your revenue is growing faster because you have more cash going out for the inventory and you have less cash coming in from receivables until you start collecting those cash flows from customers that you sold your products to over the previous several months and quarters. So then in 2025, free cash flow expected to grow. And from that period onward, from the year we saw, the Wall Street analyst, 2027 was the last year of those estimates I'm utilizing. So from 2027 onward, I'm utilizing the free cash flow estimate I've incorporated here. The short-term growth rate in free cash flow, I'm estimating at 35%, and then it's settling down at 17.5% between the years 2028 and 2034. When we take the present value of all of those cash flows, we arrive at $22.5 billion. The reason we need the present value and not the actual value is because money in the future is worth less to us today. We need to incorporate a discount rate, which is called the weighted average cost of capital. For Supermicrocomputer, I have that at 11.84%. I give the company a cost of debt of 8.5%, a cost of equity at 12.5%, utilizing a beta of 1.28, risk-free rate of 4.75, and a market risk premium of 6%. Since the market cap is $19 billion and the company's total debt is $2.2 billion, I've given them a target capital structure of 15% debt and 85% equity. So when we take the present value of all those cash flows, we arrive at the value of operations at $70.78 billion. To that total, we need to add the company's cash and subtract the debt, and we get a value of equity of $70.35 billion. When we divide the number of shares outstanding of 642 million, we arrive at an intrinsic value per share of $109 for Supermicrocomputer. The current market price is only $32 per share. So if these numbers are accurate, and this is an even bigger if for Supermicrocomputer because of the question marks surrounding its financial reports, it's a bigger if than usual. If these numbers are accurate, the intrinsic value per share of $109 compared to the current market price of 32 would suggest that this stock is undervalued. However, I cannot make that conclusion with this stock because when we're dealing with numbers in the future, there's already a certain amount of uncertainty and risk, right? Because nobody knows what's going to happen in the future. So there's a great deal of risk that you're taking by incorporating these estimates and assumptions about future cash flows. That risk is multiplied when you're questioning the company's management team and their financial reports, whether or not the numbers are accurate, whether or not the numbers are presented with transparency, and whether or not they're in shareholder interest or if they're inflating numbers to try and make their figures look better than they actually are. These are all question marks, right? Because of the difficulties and challenges that Supermicrocomputer presented investors in 2024 with the developments and the late filing and the question marks around its financial statements. Even its auditor resigned and made a statement saying that the auditor did not believe that the company's management team was communicating with them with faith, that they believed that maybe they were hiding some numbers, they weren't being as transparent as they would feel comfortable with, and so they didn't want to work with Supermicrocomputer any longer. So big question marks remain with Supermicrocomputer, even more uncertainty regarding these figures. However, if the figures turn out to be true, then you could be getting an undervalued stock here at current valuations. However, you are taking that extra risk here with Supermicrocomputer in taking these numbers into account.
Hey everyone, if you like watching my videos, then I've added a great complimentary product just for you. I've written a book that's available for sale now that highlights my 6-step investing framework. Even if you don't follow that investing framework, just reading it and knowing how I evaluate stocks will make it a lot more interesting and informative to watch my videos. I've added the link in the description below.